Hey there, investors! Today we're diving deep into the world of the Producer Price Index, or PPI. This crucial economic indicator is like a crystal ball for the market, giving us a glimpse into where prices might be headed. Simply put, the PPI measures the average change in prices received by domestic producers for their goods and services over time. Think of it as a measure of inflation at the wholesale level. It's released monthly by the Bureau of Labor Statistics, and believe me, Wall Street watches it like a hawk. Why should you care about the PPI? Because it can signal future inflationary pressures before they even reach consumers. When producers face rising costs for raw materials, energy, or labor, they often pass those costs along the supply chain. Eventually, these price hikes can trickle down to you and me at the checkout counter. By keeping an eye on the PPI, we get a sneak peek at what might be coming down the pipeline in terms of inflation. This information is crucial for investors because it influences everything from interest rates and stock prices to the value of the dollar. So, buckle up because understanding the PPI is your secret weapon to navigating the markets. Now, you might be thinking, Jim, doesn't the Consumer Price Index or CPI already tell us about inflation? And you'd be right, but the PPI and CPI are like two sides of the same coin. They both track price changes but from different perspectives. Remember, the PPI looks at prices from the producer's point of view. It captures the costs of goods and services at various stages of production, from raw materials to intermediate goods, and finally to the finished product. The CPI, on the other hand, measures the average change in prices paid by urban consumers for a basket of goods and services, like food, housing, transportation, and healthcare. It reflects the prices we see on store shelves and in our monthly bills. While both indices provide valuable insights into inflation, the PPI often acts as a leading indicator for the CPI. Changes in producer prices can take time to filter down to the consumer level, but the PPI gives us a heads up that changes are on the horizon. Now let's talk about core PPI. This measure strips out volatile food and energy prices, which can swing wildly due to factors like weather events and geopolitical tensions. But hold on, Jim, you might be thinking, why ignore food and energy? Aren't those important? They are. But their prices tend to be more erratic and less indicative of broader inflationary trends. Core PPI gives us a clearer picture of underlying inflationary pressures, focusing on more stable sectors of the economy. This helps policymakers and investors identify more persistent and systemic price changes, allowing for better informed decisions. Think of it this way. Core PPI is like filtering out the noise to focus on the signal. This helps us determine whether inflation is truly becoming entrenched, or if it's just a temporary blip caused by external shocks. So, how does the PPI impact the markets? Fasten your seatbelts because this is where it gets exciting. First up, let's talk gold. Gold is often seen as a safe haven asset in times of inflation. When the PPI rises, signaling potential future inflation, investors often flock to gold as a hedge, driving up its price. Conversely, when the PPI falls, suggesting easing inflationary pressures, gold may lose its luster, causing its price to decline. Now let's move on to stocks. A rising PPI can be a double-edged sword for the stock market. On the one hand, it can signal a strong economy with businesses able to pass on higher costs to consumers. This can lead to increased corporate profits and potentially higher stock prices. However, if the PPI rises too quickly, it can raise concerns about inflation eroding corporate profits and stifling consumer spending. This can create uncertainty and lead to stock market volatility. The impact of PPI on specific sectors can be varied. For example, sectors like energy and materials, which are directly tied to commodity prices, often benefit from a rising PPI. On the other hand, consumer discretionary sectors like retail and automobiles may face headwinds as rising costs could dampen consumer demand. And what about our favorite indices? The S&P 500, Nasdaq, and Dow Jones are all influenced by PPI data. A higher-than-expected PPI could spark fears of inflation, leading to a sell-off in the stock market and a decline in these indices. Conversely, a lower-than-expected PPI might boost investor sentiment, potentially leading to a rally. But that's not all. PPI data also has a significant impact on currencies. A strong PPI indicating a healthy economy and potential interest rate hikes can boost demand for the US dollar, causing it to appreciate against other currencies. Conversely, a weak PPI might lead to a decline in the dollar's value. Even the crypto world isn't immune to the power of the PPI. A surge in PPI data can lead to a risk-off sentiment in the market as investors flee to safe haven assets like the US dollar, potentially putting downward pressure on Bitcoin and Ethereum prices. Remember though, market reactions are seldom straightforward. Markets are forward-looking and factor in not just the actual PPI data but also forecasts, other economic indicators, and crucially, what the Federal Reserve might do in response. So there you have it. The PPI is a powerful economic indicator that provides valuable insights into inflation, interest rates, and the overall health of the economy. By understanding the PPI and its far-reaching impact, you'll be well equipped to navigate the exciting world of investing.